So this is hybrid accounts, and right now we're just going to study IAS 40 investment property. What is investment property? Now, to get a grasp well, IAS 16 PPE speaks of property, plant, and equipment. Now, you note one thing. You note that there is property there, but also we have property here. So, the first and at most important thing is that you should know what we mean by the term property when we speak of the international accounting standards. By property, we mean either land or building, right? So whenever you find anything that is neither land nor building, that is not investment property. So you cannot follow the principles of this in IAS 40 to account for that item, right? Okay, so just as an introduction, we just say that an entity may own land or building is an investment rather than for use in the business. If you have land or building and you are using it in the business, right, for investment, if you are using it in the business, it is not called investment property. If you're using it in the business, it is classified as property plant, it is classified under property, plant, and equipment, that is IAS 16. That's why you're specifying that at the very early stage. So simply speaking, we'll take a look at this definition and we'll know how land and building is defined under IAS 16 and how it is defined under investment property here. All right, so what do we mean? You know, if something is just held for investment, we usually mean that it can generate cash flows that are largely independent of other assets. And what do I mean by this? You know, when you have, let's say you have a building and you have just rented it out to someone, you do not need any other asset to help you generate cash flows. That building alone, by just renting it out alone, you are entitled to receive the cash flows. And what do we say? We say that it can generate cash flows largely independent of other assets. Regardless of whether you have other assets or not, you can actually make an estimation of the cash flows expected from the renting out of that building. So this is what we call investment property, and this is the reason we distinguish investment property from other properties classified under IAS 16 PPE. All right. So we can now determine the definition of the investment property and distinguish it from other standards. Take a look at this definition. You know, when studying international accounting standards, you can find that the definition is long, but it's not like you are just going to memorize that definition. It is long so that you understand what is really meant, and after that, you will just remember everything naturally because you have understood the scenario, because you know you apply the standards. All right. So we say that investment property is the property, as I told you, property could be land or building, or maybe part of a building, or both, held by the owner. Now be careful, held, I'm speaking of the word held. Held, not necessarily owned. You know, if you are holding something, it does not necessarily mean that you are owning, you own it. You owning it means there is a legal, actually legally you own it. But when we say held, that's why we say by the owner, maybe you own it, or by the lessee is a right of use asset. You know, you might have leased actually land, or maybe a building, you might have leased it. So if you have done that, we usually record the right of use asset. You will find that one in IFRS 16 leases. So if you are holding it, that means you have control over it, even if not indefinitely, even if it's just for a specific period of time, but actually you're entitled to the right of using it. So we call that, we say that you have the right of use asset. Okay, so now the last point here is this property should be used to earn rentals. Either you earn rentals made by renting out the building, or for capital appreciation, or both of them. So this is what we call investment property. Rentals, capital appreciation, or both. And then we specify rather than for. Now this rather than for, part A, specifically explains property that is classified under IAS 16 PPE. So it is rather than for use in production, supply of goods or services, or for administrative purpose. If you find out that something is under this use, this property should be classified under IAS 16, property, plant, and equipment. As you know, if you are doing something for production, that means it makes production. After producing, you'll expect other assets to make sure that the asset is sold. And so it does not generate cash flow that are largely dependent on others. So it could be for, let's say you have a machine, that machine can be used for production, or maybe let's say you have a car, that car maybe could be used for the supply of goods or services, or maybe it could be for administrative purpose, right? So this part A actually explains IAS 16. I would like us to write it down. I would like us to know that when I speak of this part A here, I actually refer to IAS 16. The property spoken of here is on I-16, but also rather than use it for sale in the ordinary course of the business. What do I mean by that? You know, when you are saying that something is used for sale in the ordinary course of the business, let's presume that maybe you have those, for example, those automation housing, those actually those companies that are or institutions that are therefore building houses with the aim of selling them. In that case, that one is called inventory, and the inventory is explained under IAS 2. Right. So we define investment property under IAS 40, but we say that if you have land or building that is held for sale in the ordinary course of the business, that one should be inventory. But also, if it is used for production, supply of goods or services, or for administrative purpose, that one should be used under IAS 16 PPE. I hope you got the true meaning of investment property. You know now what I mean by investment property. All right, the standard is very short. It's all about land and buildings. All right, now we proceed and say that an investment property, unlike other properties, generates cash flow that are largely independent of other assets. I think we have spoken of it already up there. Held by the entity, and in that sense, such properties do not form part of entity's normal operations. That's why it's not considered as part of business, but rather a separate investment. Now, let's take a look at some examples of investment properties. Investment properties could include the following. As I've said, we could have land and buildings. So, land held for long-term capital appreciation. This one is obvious. We have been told you are holding land for capital appreciation. And we say the definition of actual investment property are that it should be used for rentals, accumulation, or capital appreciation. So it's obvious that we are told that it is for capital appreciation rather than short-term sale in the ordinary course of the business. For the short-term sale of the business, this one should have been inventory. All right. Another example, we could say a building here owned by the reporting entity held. We have said a building owned. Simply speaking, we could say a building held, either owned, as I told you, or held by a variety of use asset and leased out under an operating lease. You have a building, you are holding a building, but you have leased it out to someone else under operating lease. You know there is a difference between operating lease and a finance lease. If you say operating lease, it's kind of you still actually continue to control that asset. But if you say the finance lease, it's like you have actually given control to the lessee. You as the lessor have given control to the lessee. So we mean that you still have the control. And so we say that this one is an investment property. Let's say I have just built my building and leased it out to someone. Or maybe I've leased the building, I've got it from someone, I'm a lessee, but also I've sublet it. I've subleased it to someone. It should also be an investment property. So this is what I was just trying to speak of. And maybe you have part C, example C, a building held by the parent and leased out to a subsidiary. Be careful here. This one is usually very important. You know, in financial reporting, there is something called consolidation of financial statements. If you are a company and maybe you have purchased shares of another company, usually more than 50%, you will be controlling that in company and you will be seeing it as a subsidiary. And now when you are required to prepare the financial statements, we usually have to prepare the group accounts, the combination of the parent, which is you, and the subsidiary as a single economic entity, right? So a building held by the parent and leased out to a subsidiary, no problem, we just do it the same way. It doesn't matter that you are in the same group. As long as you have leased it to a subsidiary, we say that it's just an investment property, just like for part B here. But why did I specify it here? This is the aim now. Not, however, that while this is regarded as an investment property in the individual parent company financial statements, now in the consolidated financial statements, when you consolidate matters, if I'm a parent and you're a subsidiary and we will do a consolidation, that means we combine our assets together. If we combine them, I actually say that I leased out something to you, but if you combine them, it's like I have it in my own books. And so if it's my own books, it's like I'm using it for my own use. And so it stops being an investment property when you're preparing group accounts. So in the separate financial statements of the parent, it should be an investment property. But when the parent actually is consolidated with its subsidiary, we call it an owner-occupied property. That's why we say in the consolidated financial statements, this property will be regarded as owner-occupied. Do you see this, owner-occupied? If it's owner-occupied, we mean that it cannot be classified under investment property anymore, and it should be classified with a reference to IAS 16. All right, this is what I meant, because it should be part of a group, and in that group the parent exists. All right, you could have another example here, example 4, property that is being constructed or developed for future use as an investment property. I think this one is obvious, right? But actually you're not done with the examples. Let's presume that maybe you have bought land, but you have not determined the use for that land. So land, the future use of which is not actually identified already, can just be considered that way too. That's why we say not. If an entity has not determined that it will use the land either as owner-occupied property, that means for owner use, or for short-term sale in the ordinary course of the business, then the land is considered to be held for capital appreciation, and so that land is considered to be an investment property. So simply speaking, land, I could say here, example E, land, the future use of which is yet to be determined, right? Yes, so that one could be an investment property again. All right, let's just check at the other considerations here, but we are just basing there on the property that is land and the building, other considerations. All right. Now, this one is just a normal thing. It's just logical. It says that if a part of property is held for investment and the other is owner-occupied, just presume that you have a 4-story building, and then you have decided maybe to use some for investment property to lease it out to some people, and some to use it for your own, maybe for your own business. So we say that that story building actually, as part of it is an investment property, but also part of it is a property that is owner-occupied. So part of it should be accounted for as IAS 40 and part is per IAS 16. Now we say each part shall be accounted for separately, but under certain conditions. If the parts can be sold or leased out under finance lease separately. Did you get this point? Again, I'm repeating, if the parts can be sold or leased out under finance lease separately. By saying sold or leased out, I will just mean one thing. If you say sold, if you sell something, that means you have lost control over it, right? That's why the other option of saying I've been sold is to lease it out under finance lease. Because as I told you, if you lease it out something under finance lease, it's kind of you have lost control over it, right? So that's why you're just saying if it can be sold or leased out on the finance lease separately. So just check. If you can do that separately for each one, then we say, oh, so each one can be accounted for separately, right? Now, suppose that one is not possible. Just presume that, oh, this one I'm using it as an investment property, and the other one is the property, plant, and equipment. All right, can I sell them separately? I cannot do that. So we say, else the property shall be classified as investment property if owner-occupied part is insignificant and vice versa. So you just have to consider the part which are actually, if some part is insignificant, actually, you just take that one that is more significant and account for it for the whole property. All right, this one is another consideration. We say that ancillary services to the occupants of the property. Do you know about ancillary services? You might have a hotel, you may be owning maybe a hotel, and maybe or maybe we may just be holding, let's say something for guests who come there and maybe sleep and maybe pay you. And maybe you may also put out a cafeteria so that they can be getting the breakfast there, maybe their lunch, the dinner, things like that. And so that is what we call auxiliary services to the occupant of the property. Some people occupying the property, but also you are giving these auxiliary services. Let's presume it this way. So we say, if auxiliary services are insignificant in relation to the whole arrangement, classify it as an investment property, right? Yes, just classify it as an investment property if they are insignificant, because if they're insignificant, it should be like we have just rented out a building, people are staying there, they are paying you. But if significant, if auxiliary services are significant, we mean that, oh, people are just sleeping there. We just mean that, oh, maybe you just decided to attract people. Your main aim was to open a cafeteria, but to be sure of having the customers, you decided to put out premises just for customers, to hold customers, so that you can be sure of the demand. So that's why you're saying, if significant, classify it as the owner-occupied property. So that is what we usually do. These are just normal considerations that you just have to know, all right? Okay, now this one is part 2. You know, this standard is very short, as you see here. Just after doing some, maybe we're just going to be done with it just in a moment. It's a short standard, actually. All right, now let's go to the second page. And we are just still on those. We're just trying to grasp the true meaning of that one, investment property. So below are just examples of items that are not investment property. We are told specifically that these ones are not investment properties, but we have seen it already in the definitions for most of the parts. Okay, property intended for sale in the ordinary course of the business. As I told you, this one is inventory. If you're holding it for sale in the ordinary course of the business, but also we are saying that property being constructed or developed on behalf of third parties. This one is obvious. You are just making a story building, maybe someone has come and need that one, and maybe you are a construction company, you are just constructing that. It's obvious that it does not belong to you. It doesn't belong to you, just doing that on behalf of third parties. So you just expect revenue. You just expect to build it, not to own it, but to be paid actually and to earn revenue. So property being constructed or developed on behalf of third parties is accounted for as per IFRS 16 revenue from contract with customers. No worries, I will also share this one. It's a very, very important standard, even for, especially for this level, SPR. I just prepared it well and I'll share it soon, but for now, let's just leave that alone. So, and then we have owner-occupied property. As I told you, for owner-occupied property, if you have the property and you occupy it by yourself, you leave it there, for example, or maybe use it for the business. We say that use a 16 property, plant, and equipment. So this is how we go about that. Now let's just take a look at the definitions of what we have been going through. The standard, as I told you, is short, you know. What is unoccupied property? I've been speaking of this all this while. Unoccupied property is just the property held by the owner, right? Or maybe by the lessee as a right of use asset. Simply speaking, the property held by someone. But right here, for use in production or supply of goods or services or for administrative purpose. Don't you see that this point here was is for investment I-16 property, plant, and equipment? We just took a look at the definition above. We just took a look at the definition of investment property and we saw all this, right? We said that an investment property should be sorry, I don't know what this is. We just spoke at the definition of the investment property here. We said this is a property held for rentals or capital appreciation, but rather for production, supply of goods or services, or for administrative purpose. And I said this one is for I-16 property, plant, and equipment, and that is what we have seen under owner-occupied property. All right. So I hope you just get this even better. And now we have the other definition, fair value, or this wasn't very important. Actually, it is all defined under the conceptual framework. It's the same definition as per the conceptual framework. The fair value. You know, when you need to know about the fair value, you know, let me tell you one thing. Maybe I could just remind you something. In the conceptual framework, we just try to look at the ways of measuring items, let's say assets and liabilities. And we say that we could have historical cost, but also we could have something called current value. If you mention the word cost on assets, we mean that how much did you incur to acquire something, the amount you incurred to acquire something. But when you speak of fair value, you know, when you incur the amount to get something, ultimately you could need to sell back that thing. So if we speak of fair value, we speak of the amount you could recoup back by selling what you already have. So that's the contrast between fair value and cost. Whenever we see something is a cost, we mean what you should have done to acquire something. Again, cost is here. Maybe let's see it down here. Cost is the amount of cash equivalent paid or fair value of other considerations given up to acquire an asset at the time of acquisition or construction. You just see this. While fair value is say that you have something in your possession and you need to recover some amount from it. So you try to sell it if it's an asset. That's why we define it as it is the price that would be received to sell an asset, right? Or paid to transfer a liability. No problem. This one is not essential. You know, we are just speaking of investment property, and property is an asset. So if this one paid to transfer liability is not important in your situation, right? You can just ignore it. Because here you just need the fair value for an asset. In an orderly transaction, if you say an orderly transaction, that means it's a normal transaction. Do not say that, oh, you need to sell something maybe, but you have a lot of problems. You are just selling it out of problems. You could find out that something has a fair value of 10 million, but you sell it at 6 million. And that's why we ignore that. And we say that in an orderly transaction, the transaction should be normal. People do not have problems, for example. Again, between market participants, what do we mean by market participants? By market participants, we mean that business occurs between people who have sufficient information about the market. Do not say that you are just selling to someone a thing that is worth $5 million, but you sell it for $12 million just because, and they are ready to purchase just because they are unaware of the market, they lack information. We cut that out. And then the last point we say at the measurement date. At the measurement date, we specify this because, you know, fair value can be volatile. It really depends on the type of asset you are speaking of. Some asset, you might find out that fair value today is $5 million, maybe 1 week later it's $5.5 million, a week later again, maybe it's $4.5 million, so it changes. And that's why we specify the measurement date too. So I hope when you see the definition of fair value, there are things that come into our mind to know how to spell it out. All right, and the last point, the carrying amount. Oh, I hope you know this, man. You know, when speaking on the carrying amount, it's just the amount at which an asset is recognized in the statement of financial position. Let's say you had the cost, let's say you depreciated it, and maybe you have an accumulated depreciation of 2 million, but the asset was acquired for 10 million. If you less, you would have 8 million. We normally call it net book value, right? This carrying amount. So that's what it's the amount at which an asset is carried in the books, right? Okay, so I think we have already got the real meaning of investment property, and now we can just proceed in a better manner. All right, now when you say that you just have an investment property and you need to put it in the financial statements, that is what we mean that you are just going to recognize it. So this is the meaning of recognition. If you say the word recognition, that means you recognize an asset, you incorporate an asset into the statement of financial position, right? Okay, so there are normal things here. These are conditions for recognition are just normal. Investment property should be recognized as an asset when two conditions are met. Whenever these two conditions are met, an investment property would be eligible to be incorporated into the financial statements, especially the statement of financial position, I mean. First of all, without seeing those ones, it should really, if you say you have an asset, that means you expect economic benefit from it, right? Because you cannot say you have an asset, but actually you not expect any economic benefit. That would no longer be an asset, right? It should just be maybe an asset in disguise, not a real asset. So this is the first point. It is probable that future economic benefits associated with the asset will flow to the entity. This is the first point. But also, let's say that, oh, maybe I have an investment property. I have a building, and by that building, maybe I'm just renting. I've rented it out, so I expect actually to receive the rentals, which are the economic benefits. But maybe you do not even know the cost of that investment property, the cost of that building. If you do not know its cost, how can you recognize in the financial statement? Yes, it's true, it's an asset. But at what amount are you going to recognize it? If you cannot know that, you obviously cannot recognize it. So measurement should usually go alongside recognition. You cannot recognize something without being able to measure it reliably. And so here comes the cost of the investment property can be measured reliably. All right. As long as you have a reliable measurement, you could just do that. Don't worry about this. Even when you study PPE, property, plant, and equipment, you would find out the same conditions to recognize an asset. All right, then let's go to we have just spoken of the measurement. Now you just need to know how to measure it so that maybe you can truly recognize it. Measurement, how do we do it? Measurement, initially when we recognize something, you should know at what amount to recognize. That's why we say we'll deal with both initial measurement, that is measurement on initial recognition, and so it's like subsequent measurement. So starting with the initial measurement, how are we going to do this? On initial measurement, we say that an investment property should be measured initially at its cost, including transaction cost. Let's say maybe you acquired the building for $10 million, but maybe you had to incur some transaction costs, maybe some legal fees. You had to pay them out. You just have to pay them. Maybe you had to pay $1 million, and then you would have a total of $11 million, and that should be the initial cost of the investment property recognized. But after that, time passes. When time passes by, what are you going to do? That's what we call subsequent measurement. But let that alone, it really depends on how you acquired this thing. And that's why you usually say one thing. Let me tell you. You could say that initially it should be measured at its cost or deemed cost. There is something we call deemed cost. In some situations, depending on how you acquired an item, you could find out that you measured at fair value. That's just an example. And actually, it is explained very well under 16 PPE, but I would just like to mention it here. For example, maybe presume that you have acquired, you are holding investment property by the way of lease. Someone has leased it out, you have it, and maybe you say that you have the right of use asset. A right of use, you say that a right of use asset classified as an investment property should be measured in accordance with IFRS 16. IFRS 16, this one is leases, and actually you just know when you reach to leases how to measure this. Simply speaking, we usually measure, you just count, maybe you expect to receive $50 million in the first year, another 50 at the end of second year, another 50 at the end of third year. Then you just take the present value. And then you would have the right of use asset. Maybe if there was transaction cost, you would have to add them, okay? So that's what you do. It really depends on how you have obtained it, right? So before going to subsequent measurement, I would like to specify one thing here. There are several ways of acquiring investment properties, ways of acquiring investment properties, ways of acquisition, I could say, you can acquire it in several ways. First, maybe you could say that you have acquired through purchase. Say you could use the cost most of times. Let's say you have acquired through lease. You have leased it out. We have seen about that. Maybe you could acquire it through maybe partly you pay, but maybe you also get a government grant. There's something called government grants. The government has helped you somehow. And maybe you could say that you have constructed you have constructed it by yourself, right? This one is very possible. Constructed, self-constructed. Self-constructed, you could just say, I built it myself. Then maybe you could have something called exchange. You know, you could exchange some assets, right? You have an asset, you exchange with another. Maybe you exchange to acquire another asset. Let me show you an example here for this exchange. Because of the exchange, let me just think of it again here. For an exchange, it really depends. For an exchange, we usually use fair value. Because if you exchange, you do not incur the cost, so you cannot say you measure it at cost. You measure it at fair value unless it is impossible. So we measure it at fair value unless maybe no fair value, neither you cannot determine the fair value of either of the assets. So no fair value, or maybe no commercial substance. No commercial substance. We say that unless the transaction may lack commercial substance. So in case there is no fair value, there is nothing to do, or maybe there is a fair value, but there is no commercial substance. If no commercial substance, also you cannot do that. And by commercial substance, what do I mean? You know, by commercial substance, we just speak of the implications on cash flows, implications on cash flows. And by implications on cash flows, what do I mean? We usually speak of the three things. We speak of risk, amount, and then timing. If you find out that you are exchanging asset, let's say you're exchanging maybe a Ferrari for a Ferrari, the same thing, maybe both Ferraris have 5 years remaining useful life. You find out that the risk is the same, amount is the same, but timing is the same again. We say that there is nothing important in exchanging those things. So in case there is something like this, you cannot do that. And maybe I could tell you, they usually don't say, but I just made a judgment and find out that as long as we are speaking on the implications of cash flows, what they really mean is usually this one. You know, speaking of cash flows, we usually take the present value of future cash flows to obtain the worth of something. And how do we obtain the present value? The present value equals to future value over 1, and then we plus R, and again we say power n. Now take a look at this, and I think you will get what I'm just trying to say. They usually not say, but it's obvious this is the thing. I just judge it this way. You know, when speaking of the future value, this is the amount you expect to get in the future, right? When speaking of this R is the discount rate or cost of capital, and the discount rate should usually reflect the riskiness of that asset we're speaking of. But also we have N. N is usually the number of years, the timing. It depends on the number of years that asset can be used. So you can just get this one from just taking a look at the formula for present value. It's obvious that they get it from here. All right, now let me finish up one thing here. We just say that we said we usually use the fair value unless it can be obtained. So the following should be the preference. We should start with the fair value. We should start with the fair value of an asset given up. You are giving up your asset to acquire another, so we check its fair value and recognize. If it does not exist, maybe you take the fair value of an asset acquired now. Acquired. And in case that is not possible, then no problem, just use the carrying amount. That's just use the carrying amount of an asset given up. So use the carrying amount of your own asset that is already in the books. And what would I mean by that? By that, I could mean that, let's presume that maybe you have an asset with a cost, with a carrying amount of, let's say, 20 million, but you need to acquire another asset with a carrying amount of 25. Your asset has a fair value of 26 million, but maybe the other one also has a fair value of, let's say, 23 million. Let's say you have asset A, and then that other one is asset B. You have asset A here, and this one is asset B, right? So in order to do that, you just do the following. I'm giving up asset A, so I'm just recognizing it. So I'm crediting If it closes, actually just have to join back, right? I think the time is almost over. So I would have to remove my asset A at its carrying amount, that is 20. And then I would have to recognize the new asset, right? Asset B. I would have to debit asset B at the fair value of asset given up, asset B, which is 25. So if you do 25 here, you find out that to balance this one, I'd have to add the credit balance here of how much I should add some 5 so that we balance, and say then I should say that I have a gain of 5 which goes to the statement of profit or loss, right? Yeah, this one should go to the statement of profit or loss. So this is all about acquisition of the investment property.